Let's talk about a different kind of war, a financial war. Not fought with tanks, but with interest rates, currency swaps, and quantitative easing. This is the story of a financial Cold War between the United States and China, where the goal is to control capital, not territory. The US controls the world's most important currency, the dollar. That's a superpower, almost invisible, but incredibly potent. America uses this advantage to create economic turbulence for its biggest rival. The global financial system is the battlefield designed by and for the West. When you control the rules, you can change them at will, make it rain money, or create a drought. The US manipulates the flow of money to keep China's economic rise in check. This isn't a secret conspiracy. It's all there in Federal Reserve announcements and Treasury bond auctions. The real drama isn't at the UN. It's in the plumbing of the world's financial system. Two giants are locked in a high-stakes poker game for the future. One holds the house advantage, the other is learning to play by its own rules. And this war, it has no clear end in sight. It's a slow-burn thriller, unfolding right now, so buckle up, because things are about to get fiscally weird. Welcome to the silent war for global economic supremacy. Let's see how it all began. Let's rewind to 2008. The global financial system was imploding, and the US was desperate for help. Enter China, the world's factory, sitting on a mountain of US dollars. When the US issued massive new debt to bail out its banks, China became the biggest foreign buyer. In effect, China was lending America the money it needed to save itself. A communist state bankrolling a capitalist superpower. Strange, but true. By buying US Treasury bonds, China kept American interest rates low and helped stabilize the global system. But this created a deep, unspoken dependency. The US owed China not just money, but a debt of stability. China gained leverage, holding a significant portion of America's IOUs. Washington was uncomfortable. The power dynamic had shifted. The 2008 bailout was a turning point. America saw China as more than a trading partner. It was now a creditor with influence. The crisis exposed US fragility and showcased China's rising financial might. The unspoken question: what happens if the lender calls the shots? This anxiety would shape the next decade of US policy. The seeds of the financial war were sown in the ashes of the 2008 crash. From here, the rivalry would only intensify. The stage was set for a new kind of conflict. The world would never be the same. The US and China were now locked in a financial embrace, one that neither could easily escape. The balance of power was shifting, and both sides knew it. The financial war had begun. Let's see how China responded. After 2008, while the West was recovering, China was booming. Skyscrapers rose, high-speed rail spread, and Chinese tech began to rival Silicon Valley. China was no longer just the world's factory. It was becoming an engineer, banker, and innovator. Projects like the Belt and Road Initiative expanded China's influence across continents. China was building a parallel economic universe where the dollar wasn't king. This challenged the post-Wu order America had dominated for decades. In Washington, quiet panic set in. The old belief was that a richer China would become more like the West. But China got rich on its own terms, under its own political model. This was an ideological and economic threat. Alarm bells rang. China could set its own standards, create its own systems, and project power globally. The era of friendly engagement was over. America needed a new strategy to slow the dragon down. Military conflict was unthinkable. The battlefield would be financial. How do you fight a war without firing a shot? With America's financial system. The US dollar is the world's reserve currency. Everyone needs it to trade, invest, and pay debts. The Federal Reserve can make dollars cheap or expensive for the entire planet by adjusting interest rates. The US Treasury bond market is the world's safest haven. In times of trouble, money floods into American assets. This strengthens the US position even when it causes the instability. Wall Street's banks, hedge funds, and rating agencies are the foot soldiers, moving capital and amplifying US policy. Negative reports, short selling, and capital flight can trigger crises abroad. The strategy used the dollar, treasuries, and Wall Street to put pressure on China's weak spots. It's a coordinated dance: maximum financial pressure, minimum visibility. The goal isn't destruction, but containment. Keep China on a leash woven from dollars and debt. The US can start a fire and sell the insurance. It's ruthless, but effective. The stage was set for a new kind of great game. The world would soon feel the impact. The financial arsenal was ready. The squeeze was about to begin. Here's how the financial war works. Create a dollar shortage. Imagine you're a Chinese property developer. For years, you borrowed cheap dollars to build. Suddenly, the Fed hikes interest rates. Your debt gets more expensive overnight. The dollar strengthens, the yuan weakens. You need more yuan to pay the same dollar debt. Investors pull money out of China, chasing higher returns in US assets. Capital flees, the yuan drops, and China's central bank burns through reserves to defend its currency. It's a vicious cycle. The more money leaves, the more pressure on the yuan, the more reserves are spent. Years of easy money fueled China's growth and asset bubbles. Then, with a flick of the Fed's switch, the US reverses the flow, sucking capital back, leaving China with collapsing bubbles and debt. It's legal, technical, and utterly ruthless. No soldiers needed, just monetary policy. The art of the financial squeeze is in the details. The US pumps capital in, then pulls it out at the worst moment. Chinese companies scramble to repay dollar debts as their economy slows. The pressure is relentless. The goal destabilized China's growth model. The result, a crisis that ripples through the entire Chinese economy. This is financial warfare at its most sophisticated. The squeeze is on, and the consequences are real. This wasn't just theory, it happened in waves. In 2015, the Fed signaled rate hikes. Capital fled China, the stock market crashed, and reserves plunged. In 2018, the Fed hiked again, and the Trump administration launched a trade war. China faced a double blow, strong dollar and tariffs. The goal hit China's exports and financial stability at once. By 2022 to 2023, the Fed's aggressive rate hikes created a huge gap between US and Chinese returns. Chinese companies faced a debt maturity crisis, dollar loans coming due just as the economy slowed. Each episode was a calculated stress test, probing China's weaknesses. The interest rate shock of 2015 was the opening shot. The trade war and rate hikes of 2018 were the main assault. Post-pandemic hikes aimed for the knockout blow. This was a masterclass in financial warfare. The tools were boring interest rates, tariffs, but the impact was seismic. The financial war was in full swing. Where did the pressure land? The property market. Real estate was China's economic engine, fueled by cheap credit, much of it in US dollars. When the US squeezed, Chinese property giants like Evergrande faced impossible debts. Defaults followed, sending shockwaves through the economy. Construction stalled, suppliers went unpaid, and families lost life savings. The confidence that fueled the property boom evaporated. This was a systemic crisis, not just a few bankruptcies. The US had targeted the heart of China's growth model. The goal triggered a crisis of confidence in the Chinese middle class. The tactic was devastatingly effective. The financial war had found its mark. Did China just take the hit? No way. Beijing launched a counter-offensive, deleveraging, stricter rules for property developers, and a more flexible currency. China built a financial defense system, making it harder for capital to rush in and out. Most importantly, China pushed to internationalize the renminbi. Currency swaps, a new payment system, and oil trade in yuan, all aimed at reducing dollar dependence. The goal, a multipolar currency world where the US can't weaponize finance so easily. It's a slow, generational project, but it's a direct response to the financial war. China is rewriting the rules. So where are we now? The era of unquestioned American financial supremacy is ending. The financial war isn't over, it's evolving. China is no longer just defending, it's reshaping the global financial system. Money is power, and the US can't wield it unilaterally forever. Every time America weaponizes the dollar, it pushes others to find alternatives. The future? A fragmented, multipolar monetary world. Dollar and yuan side by side. This will bring new risks, new opportunities, and more turbulence. The great struggles of our time are fought with bonds, not bombs. The silent war for the future of money is underway. Watch the flow of capital. That's where the real story is.